Brad Williams, Frugal Finance. Let's continue discussing hedging. Here, the idea that you may be at risk in a certain commodity without actually owning it may be confusing to some, but consider the following example. Silver is required input for the assembly of most types of photographic films and papers, and the price of silver is somewhat unpredictable. For a manufacturer of film, there is a considerable risk that profit could be dramatically affected by fluctuations in the price of silver. If production schedules are to be maintained, it is an absolute requirement that silver be purchased in large quantities on a regular basis. Assume that the film manufacturer needs 50,000 troy ounces of silver in 2 months and confronts the silver price shown in table 4.7 on May 10. The current spot price is 105.2 per ounce, and the price of the July futures contract lies above that at 106.8. That's a huge spread, with S&P futures contracting trading at 108.4. And so this is May, and you need silver within, what did it say, 2 months? June, July. Now we have to think, when does the July futures expire? How many ounces are there per futures contract? The COMEX trades silver contract for 5,000 troy ounces. You need 50,000 troy ounces. Fearing that silver prices may rise unexpectedly, the film manufacturer decides that the price of 106.8, the July futures, and to store the silver for 2 months. The price differential of 15.5 cents per ounce would not cover his storage costs. Additionally, the company will earn a sizable profit even if he pays 106.8 for the July silver delivery. Paying a price higher than 106.8, however, could jeopardize profitability seriously. With this reason in mind, he decides to enter the futures market to hedge against the possibility of future unexpected increases in prices, and accordingly, he enters the trade shown in table 4.8. The May 10th anticipates the need for 50,000 troy ounces in 2 months, so it's May 10th. So he needs it on July 10th and expects to pay 106.8 cents per ounce, or a total of $534,000. Buys 10 5,000 troy ounce July futures contract at 106.8 cents per ounce. Come July 10th, the spot price of silver is now 107.0 cents per ounce. The manufacturer buys 50,000 ounces, paying $535. Futures contract is at maturity. Futures and spot prices are equal, and the 10 contracts are sold at 107 cents per ounce. Ends up making $1,500 profit. Not bad. The manufacturer projects that 2 months from now in July, it will pay 106.8 cents per ounce or silver on the spot market, using the future price as the best estimate of the futures spot price. He purchases 10 5,000 ounce July future contracts at a price of 106.8 cents per ounce concurrently. This transaction is referred to as a long hedge because he purchases a future contract in order to hedge. These transactions also constitute anticipatory hedge because the trader is buying a futures contract in anticipation of needing the silver at a later date. The spot price of silver increased by 3 cents to 107.1 per ounce by July after some time has passed. The manufacturer needs the silver, so it pays the $535K to buy it on the spot market. More than anticipated by $1,500. It is important for the futures price to coincide with the spot price as the future contract approaches maturity. Thanks to this alignment, the film manufacturer can sell their 10 futures contract at the going rate of 107.1 cents per ounce. As a result, they hedge their futures position for $1,500, making a profit of 3 cents per ounce. This means that the net result equals 0 when both cash and futures outcomes are taken into account. There was no overall change in wealth, even though the cash market yielded $1,500, more than expected because the $1,500 future profit offset the excess. Brad Williams, Frugal Finance. Thanks for watching.